Hi, this is Professor Moss again, and I'm going to give you a quick overview of Chapter 5 for our personal finance class. Chapter 5 is going to be dealing with the advantages and disadvantages of using consumer credit. Now, one thing that we always want to remember that everyone is going to need credit, but you have to be very careful with using credit cards and just to be able to buy and not have to pay for it. Remember, credit costs money, and it also can encourage you to overspend, and it ties up any future income that you might need to put towards your retirement account. So as we go through this chapter, keep in mind that whenever you are buying things, stuff, always put it in the back of your mind that I'm going to wait 24 hours before I make this major purchase, because after 24 hours sometimes it helps us think a little clearer, and we're not buying on impulse, and then we come to find out we really didn't have to have or need that stuff that we were trying to buy on credit. So this chapter, the first objective is going to analyze the advantages and disadvantages of having consumer credit. Um, Most of the time when we open up charge cards, whether it be a Bank of America card or whether we've gone to Kohl's and we've opened up a credit card, it allows us to purchase items and then pay for them over a period of time. But again, it costs money, it costs you interest, there's different types of fees that are involved. So you want to try your very best not to purchase anything on a credit card unless it's absolutely necessary. The second objective of this chapter is to assess the types of sources of consumer credit. Basically, there are two types of consumer credit. You have closed-end and opened-end. Closed-in means closed-in credit means the borrower is going to pay back a one-time loan in a stated period of time with a specific number of payments. That would be, for instance, if you go out and purchase a new car, you say, I'm going to borrow $25,000 to buy this car. I'm going to finance it for 5 years, and my payments are going to be X amount of dollars every month. Generally, they do not go up. It would just be a stated amount of payment. The second type is with your open-end credit, and that means you're permitted to take loans on continuous balance, and you're being billed for partial repayment. Open-ended gets you in trouble really quick, because although it may seem like, oh, I got to have this, and I'm going to add it to my credit, that's where we tend to run up credit card bills that we cannot repay. So if you have to make credit card payments, you want to go for the closed in, where you're paying a certain amount each month and get it paid off. The major sources of consumer credit, of course, is your banks, your savings loan, credit loans, financial institution, and different things like that. You can borrow from family, um, but sometimes that does cause personal problems within families if we're borrowing from them. Objective 3 for this chapter is to determine whether or not you can afford a loan and how you can pay it back. Now, one of the main objectives of this chapter is that you know the debt to payment ratio, and hopefully you'll look at that and always know, okay, this is how much debt I have, this is how much I'm paying back, what is my ratio. Banks and credit union companies, everybody looks at your debt to payment ratio to see if you can actually afford to take out a loan with them. And objective 4 is to determine the cost of credit by calculating your interest. Right now, if you look at a credit card application, the monthly interest is like 21%. Doesn't sound like a lot if I'm only borrowing or using $100 a month, but then the next month I go and I've spent my 100, and so I add on more, and then I'm paying 21%. The APY. Make sure that you try to find credit cards that have lower interest rates. Um, so that possibly you can pay it off at the end of every month. What you should strive for is whatever you put on your credit card, you pay it in full at the end of every month. If it's not possible to pay it in full, then you always want to pay extra. If your minimum balance is $25, you want to pay $50. Always strive to pay more than the minimum balance, because they are going to charge you for that. And then objective 5 for this chapter is to develop a plan to protect your credit ratings. I know last week that Equifax went online and posted all through social media that they had been hacked. You need to make sure you protect your credit ratings. You freeze your credit if there's any possibility that your credit has been hacked, so that someone else doesn't take your identity. There are several options. You can buy the LifeLock. You can buy the credit card that has the protections built in. I know mine does. My bank also has credit card protection, identity theft, different things like that. So very important chapter, and you want to make sure that you're looking at it. Protect your identity. Don't use those credit cards. I tell my online class one thing that they could always do is, if you have a credit card, freeze that credit card in water. Put it in your freezer and freeze it. And then when you decide you want to buy something, you have to unfreeze it. And I don't mean put it under hot water to unfreeze it. Let it thaw out. And again, it's going to take 12 to 24 hours. And then you're going to say, I really didn't need that $500 TV or a video or Bluetooth or something like that. Once you learn to do that, you are going to be much better off financially. If you can't pay cash for it, then you don't need it. This is chapter 5. Again, for chapter 5, you've got your Learn Smart, you've got quizzes, you have a case study that's found on page 181 and 182. You're going to answer question 3, 4, and 5 and upload them to EagleWeb. You do not have a discussion board for this chapter, so make sure you use this time to be working on your personal finance presentation. Let me know if you have any questions, and have a great week. Thank you.